Okay, so pay attention. This is probably the most important topic of chapter number 1, perhaps of this course, and perhaps of accounting as a subject, right? So there is only one equation that you need to remember, that you need to understand in accounting, and that is the basic accounting equation. Now I will first of all provide a logic for this, and later on, when you understand the logic, you will remember what this equation is about. Okay, so when you start a business, the money which comes into the business comes from owner. Now the money that is invested by one owner of a business is called capital. Now what we do with this capital, we purchase assets for the business, right? We purchase inventory, we purchase vehicles, furniture, equipment. We purchase all those assets with the capital provided by the owner of the business, right? But sometimes this money is not enough, okay? And maybe there are certain other activities that we want to perform, but we do not want to spend this money right away. So there is another party who invests into the business, who actually provides money to the business, and they are called creditors. They're called creditors. Now creditors are the people who lend money to the business borrow money from them. So what we do from the money that we take from creditors, we again invest that money into assets of the business. Okay, now the assets that a business has in any form, they have claims towards two parties. There are two parties who have claims on these assets. Number one, creditors. Number two, owners. Now you would say the owner is basically investing before the creditors, then why did you write one with the creditors? Well, the creditors are outsiders, right? And the owner and the business owner has started that business, so basically owner's claim is secondary. It's called residual claim. Residual claim, which means whatever remains after fulfilling the claims of the creditors. Okay, so we have total assets of a business that would always be equal to claims of the creditors plus claims of the owner, right? So remember that. So this is the basic accounting equation where assets are equal to liabilities and owner's equity. What are liabilities? Claims by the creditors on total assets. And what is owner's equity? Claims by the owner on the total assets, right? So this basic equation provides the underlying framework for the recording and summarization of accounting information. And this equation needs to be balanced all the time. If this equation is not balanced, that means the kind of recording that you're doing in financial accounting is not good, not true. There is some kind of error in it. Okay, so I have told you three things. I'm gonna summarize them. Assets are purchased from two kinds of funds: liabilities, the money which is provided by the creditors, and then the money provided by the owners of the business. So there are two parties who have claim on total assets: liabilities, and liabilities means creditors, they have claim on total assets, and then owner has claim on total assets. Number three, the last thing, that this equation needs to be balanced all the time, right? So now we take these one by one and understand what are these things. What are assets? Assets are resources a business owns. So ownership is very important. If you take a car on rent, the car is with you for the day and you possess the car, but it is not your car because you don't have the ownership of the car. So ownership is the most important thing. And then these are resources, which means they will provide you future services or benefits. In future, these assets will provide you services or they will provide you benefits. Okay, one important thing which I want to clear here, the human resource. Human resource are not assets for business because they are people, and people cannot be owned. Okay, so HR, they are not assets in the terms of accounting. So when we talk about assets, they're tangible things or intangible things that are in the ownership of the business and they provide future services or benefits. For example, cash supplies, equipment, inventory, furniture, vehicle, land, machinery, fixtures, and so on. There are a lot of them. We will study them when we advance in the course. Alright, now liabilities. What are liabilities? Liabilities are claims against assets. As I told you, they are the claims by the creditors, people who have actually lended money to the business. We have borrowed from them. Since we are borrowing from them, we are getting the borrowed money, which is called debt. So debt is borrowed money, and we have an obligation to pay that back. So liabilities are obligations. Okay, liabilities are obligations. So to whom we should pay? To creditors. So creditors are the people who lend money to business, okay, and to them we owe the money. So accounts payable, notes payable, salaries payable, interest payable, so on. These are the liabilities that business has. Bank loan is a liability. If you purchase something on credit, which means you don't pay the money on the spot, you pay the money on a later date, that is also a liability. And then you have owner's equity. Owner's equity is the claim on total asset by the owner of the business, and basically we call it residual equity, a residual claim. Why? Because this is secondary to creditors. Now capital is the money which is invested into business by the owner. Drawings is the money which is taken out of the business by the owner for their personal use. If the owner of the business takes money outside of the business for personal use, for not the use of the business, it is called drawings. Okay, so in proprietorship we call it the capital of a proprietor, the owner, and in partnership we call the partner's capital. So if there are multiple partners, each one will have their own capital. Okay, so owner's equity. Owner's equity increases with two things. Number one, if the owner invests into the business in the form of money or any other asset, the owner's equity will increase. Number two, revenues. Okay, and here we need to understand what revenues are. Well, the revenues are basically the result from business activities entered into for the purpose of earning income. The key term here is to earn income. Consider yourself a software developer. You develop software and you sell them out. You provide software services. So those services are being sold to other people, and the earnings that you gain in return of those services, they will be your revenue. Okay, but what if you produce a product? For example, if you are producing pottery, if you're producing biscuits, if you're producing cereals, and you sell them out, again those products are sold to gain money, to earn something, to earn income. The income from the sale of those products is also revenue. So we have two types of revenues. One is called the sales revenue, which comes from the sale of products. The other called service revenue, which come from the sale of services. So when you sell services or products, you earn revenue, and that revenue also increases owner's equity. Okay, so revenue can be earned in the form of products when you sell them, sales. It can be fees that you gain in return of your services, and then if you provide services in general, or commissions. For example, if you're a property dealer and when you provide your services you gain some kind of commission, that is also revenue. If you have purchased the bonds of shares of another company, especially bonds, or maybe you have provided a loan to some other entity, some other business, you will earn interest on that loan or bond. So that would be also a revenue for your business. And if you have shares of other companies, you gain dividend on them, that is also revenue. And if you have something published, or you have something in the form of content which is in your name and you get royalties on that, that is also revenue. Again, the rent that you earn on the building which you have given to somebody to live in, that is also revenue. Okay, so these can be different forms of revenues. Again, revenues increase your owner's equity. There are two things that increase investment, and number two, revenues. Okay, next, there are two things that decrease owner's equity. Number one, withdrawals. Withdrawals are called drawings. So drawings are basically cash taken out of the business for personal use by the owner. When the owner take cash out of the business for their personal use, that are called drawings, and they have negative effect on owner's equity. Owner's equity decrease with them. Also expenses, when you actually hire services, then you have to pay for those services, and the money that you pay basically decreases owner's equity. So I will conclude here that there are two things that increase owner's equity: investment by the owner and revenues. And there are two things that decrease the owner's equity: withdrawals and expenses. Okay, so again, expenses can be of different forms. For example, your employees can be given salaries. They are the expenses against their services provided to the business. Then the rent you pay to other entities, that is also expense. Utilities like electricity, gas, internet, they are utilities. Tax expenses, entertainment expenses, advertisement expenses. There can be a lot of types of expenses that the business incur.